I guess.
Yeah, you did.
Yeah, we can begin. More and more people are still trying to join. Now we've got 11 participants. Welcome, guys. Okay. Yeah. Okay. I think maybe we can begin.
Hello, Muzi.
Hi, sir.
Good and you?
I'm okay. I'm okay. I'm okay. Thank you. Welcome.
Good. Thank you, sir.
Yes.
Muzi, I don't know if we want, if we're going to leave the video on or leave it off. Which is easier?
Sora, I don't get you very well. Seemingly you are far away from your microphone.
Okay, now I was going to say, do we need to leave the video on or switch it off so it's easier for you?
Oh, okay, guys. Feel free in terms of like enabling maybe the video on your end. I think maybe if you don't mind, you can enable the video, but it's not mandatory.
Okay, no problem. No problem. Thank you.
Okay, we now. Okay, I think maybe let's begin. Let's begin our job for the day. Yes. Okay. First things first. Let me start by introducing myself. Okay, I'm Muslim Shongo. Yes. Okay. I'm a postgraduate diploma graduate, just like you guys. Yeah. So basically, I'm a Swazi. I'm conducting this lesson. I'm based in Babane at present moment. So I'm gonna be helping you with your assignment. And some other financial management related questions that you may have. But okay, this is our first session, and then from here maybe we'll conduct another session whereby we will discuss other topics that are not in your assignment at present moment. Just because I believe like at Regent, this is what they do. You find that most of the question that you see on the assignment will not be in your examination. So it always best to try and broaden up your knowledge in terms of the other topics and other formulas that you maybe need to master. Yes. One more thing maybe that I want to mention, maybe to ask, does anyone here understand the Sizulu, Siswati, Xhosa? Just because at some point in time, maybe you may find that you're gonna be using those languages. Over to you guys.
So, Muzi, I can ask if you can use English, if you don't mind.
Okay, that's not a problem. That's not a problem.
Yeah, I'd also agree with that, Muzi.
Same for me, thanks.
Okay.
I agree, Muzi. Let's stick to English.
Okay, guys. Maybe let me just do this. Okay. Is your assignment with you guys? Like the question paper?
Yes, we got it.
Yes.
Have you got a copy of it?
Okay.
Yes.
Okay. And then which question can you start with?
Let's start from one, if everyone's in agreement. Let's start from one and work down. I think there's only 4 questions, right?
It's 5
Yes,
questions.
please.
It's 5 questions. Okay, then let's start from question 1, and then we jump to question 4. Just because I feel like those, okay, question 4 is very critical. Even question 1 is very critical just because a lot of people don't understand what is expected of question 1. Yes. Okay. Basically, question 1 is under which topic in your module? Okay, let me just double check here.
It's on page
It should be. It should be under dividend and dividend policy. According to my modular guide here, I'm not sure about your modular guide just because it's a bit different from mine. Yes, but okay, let me just share my screen here.
Yeah, that'll be good.
Let me share my screen for question 1. Question 1. Share screen. Share. Okay. Let me in. Okay, let me just attend to this one here. Who want to participate, but let me just do this. Okay.
Sorry, Muzi, someone is requesting access.
Okay, yes. I've just accepted those individuals. Okay, guys, can someone maybe read for us that question? No, Kanya, can you do that?
All right, guys, maybe I'll just reiterate the rules of engagement. Kindly mute yourself if you are not talking. Should you wish to say anything, please use the raise your hand feature on the Zoom. I think you can find it when you click on participants or something, and then it's right there, bottom right. Raise your hand. The facilitator will then notify, I will be notified of that. I will also be looking out for any hands that are raised. Otherwise, you can post your questions on the chat. All right, now getting into question 1. Who's this? Pukri is deciding whether to pay out 90,000 in excess cash in the form of an extra dividend or a share repurchase. Current prices are R2.40 per share, and the share sells for 20 Rand. The abbreviated balance sheet before paying out the dividend is right there. Those numbers, I do not want to sound like our ex-president,
Yes, okay.
but those numbers that you...
Thank you, Nokaya. Thank you very much. Thank you very much for that. Okay, guys, basically on question 1, okay, this particular company, okay, basically this particular company want to decide whether to pay out dividend in terms of cash or do what we call share repurchase, which means instead of paying out like dividend, they will allow those people who those shareholders who supposed to benefit that 90,000 to repurchase shares. So that's the thing that you need maybe to understand, so that you can be in a position maybe to answer this question. And then maybe let us proceed maybe to attempting to answer those questions that follows. You see, on question 1.1.
My earphones. You see long paper.
Guys, please mute your microphone if you're gonna be making noise. Okay. Okay, on question 1.1, they are saying they calculate the number of shares in issue. what is important in financial management is for one, maybe to know the formulas for calculating each and everything that is requested from them. Yes, in this case, they are saying calculate the number of shares. I guess maybe if you can have your pen and paper so that you can take notes. Yes. Okay. Okay, in this case, they are saying like calculate the number of shares in issue. Okay, the formula for calculating the number of shares is as follows: is equity divided by the current share price. Yes. Okay, equity in this case, you can see is 240,000. Okay, currently the shares sell for 20 Rand. It's simple like that. You just divide the 240 by 20. Okay, one more thing that you guys need maybe to master here is that your calculation goes in pairs. The other one would be for if the company decide to pay out that 90,000 as dividend. The other calculation, if the company decide not to pay that 90,000 but to allow those shareholders to use that money to repurchase shares in the company. So if the company in this case allow maybe the allow individuals, okay, if the company pay like the dividend out and pay dividend, your calculations should be as follows. It's 240, which is 240,000, which is equity, divide by the current share price, which is 20, the current selling price of a share, which is 20. You will get, yes, I guess maybe if you can unmute your microphones so that maybe you can discuss this. Hello?
Yeah, Muzi, we can hear you.
Yes.
So if I can
okay,
just
I don't want
hear
maybe
you.
to okay, in question 4, maybe I will share my Microsoft Word so that I can show you like the structure on how you go about maybe doing this.
Sure.
But okay, and then maybe I will twist a bit here, maybe, and try maybe to share like a notice board where I can write. I'm not sure which one to go for. Should I share the notice board right now, where I can write it?
Yeah, go for it.
Let's go for the Microsoft. Let's go for the Microsoft one, Muzi.
Okay.
Your Word. I think it's easier. It's faster, given
Okay,
the time constraint and the
that's not a problem.
cover.
That's not a problem, guys. Okay. Basically, this is what I was talking about. When you attempt question 1.1, let me share this. Where is my blank Microsoft?
I'll be looking at the participants, Muzi, on my side also, just to see if there's any questions, and I will interrupt you where there's some questions.
Okay, that's not a problem. That's not a problem. Okay, this is how we can go about answering question 1.1, guys. I hope everybody can see my screen. Hello?
Yes, we can.
Yes.
Yes, it's visible.
Okay,
Yes, we can.
you will write like this. Pay dividend. Okay, okay, that's 1.1. Let me just remove those numbers there. Okay, this is how you will answer that question. Okay, they are asking you to calculate the number of shares in issue. The formula is like this: number of shares in issue will be equal to equity divided by current share price. Share price. Okay. Let me admit current share price. Okay, in this case, our calculation will be like this. Our equity, as you can see over there, it's saying like it's 240,000. Current share price is 20 Rand. And then, if I'm not mistaken, this will give you 12,000. Am I right?
That's what I got. Yes.
Yeah,
Yes.
same here on my side.
Okay. Right now, we proceed to the second. Just because I said like this thing goes in pairs, guys. You should.
Yeah.
We pay dividend, we repurchase. Let's say now we want to repurchase. Repurchase. Okay. If the company decide not to pay out that 90,000, and then they want you to repurchase, and then let's calculate like the number of shares in issue. Number of shares in issue. Shares in issue. Okay, mind this, guys. That's 12,000. It's not money. It's not in a malangeni. These are number of shares. Please note that. Okay, now we want like to, if the company decide maybe to repurchase, we want to find out the number of shares in issue. Okay, the formula for getting this is just simple. It will be the payout. The payout divided by current share price, like this. And then in this case, what's the payout in this case? Like the amount, it's 90,000, guys.
Yep.
It's 90,000 like this. And then you have to divide that 90,000 by 20. What are you getting? If you divide that. Okay, based on my calculation, it will give you 4,500.
100.
Yes. Okay, basically these shares that we have just calculated are not the shares in issue, guys. Mind that. Okay, these are the shares that can be bought by that 90,000 that was supposed to be paid out. Do you understand that? Shares.
Makes sense.
Correct.
Sorry, come again?
Okay, you see, this company is supposed to pay out 90,000. So if it decides not to pay out that 90,000, and then this calculation that we have just done here show us the number of shares that can be bought by that 90,000. That's why we have divided the 90,000 by the current share price.
Yeah, agreed.
So it's the number of shares that can be repurchased, isn't it?
Okay. Okay, let's proceed. Just because we haven't like get the number of shares in issue, now we need to get the number of shares in issue. Okay, this is what we have to do. Just because the number of shares in available based on equity is 12,000, now we need to subtract. Okay, from that 12,000, we need to subtract that 4.5. Are you with me, guys? Hello.
I'm raising
Yeah.
my hand, Muzi.
Yes.
So now if we're minusing so we're saying 12,000 minus 4,500, what will that give us then?
7,500 outstanding shares.
Okay, guys. That's okay. That is going to give us the number of shares in issue if we've done the repurchase. I'm not sure whether I'm clear on that one. Okay, and then one more thing, guys, that you need maybe to do after this session, you need like maybe to try to make sense out of everything that we have covered here in terms of like trying to go through and understand the numbers, just because at some point in time it becomes so much difficult maybe to grab during the session everything. So you need like to give yourself even time, maybe trying to understand and what was happening and try to follow. You see, if in this case we will then subtract this 4.5 from that 12,000, we will get the number of shares in issue when we've done the repurchase. I hope I'm clear on that one. What are you getting? What are you getting?
7,500.
7,500
Yeah.
shares in issue if we have decided to go for a repurchase. We are done with 1.1, question 1.1.
Sorry, I just have a question. When you say 4,500, then you got the share can be priced. What does that mean?
Sorry?
Is that because you've got the
For shares,
4,500?
that can, okay, sorry, that can be, thanks for that, that can be bought.
Okay, cool.
That can be bought just because we are supposed to pay out 90,000 as dividend. And then for us to get the number of shares that can be bought out of that money, we need to divide that 90,000 with that 20, which is the current selling price of a share. And then now let's go to 1.2. Question 1.2 is saying the dividend per share for the first alternative, which is pay dividend. Pay the dividend. Which is pay the dividend. Yes. Okay, in this case, one thing that you need to understand here, they've been specific. We need just to deal with pay dividend, no repurchase. You get that?
Okay. Yes.
Yes. Okay, let's say pay dividend. And then now, okay, we want to get a dividend per share. Now, if we are saying maybe you want to pay that 90,000, so this is the formula for paying dividend. Okay, the formula is like this. Dividend share is equal to payout over number of shares. Number of shares in issue. Okay, I think one more thing that maybe I need to share with you guys is the fact that, okay, here, if you want to pass financial management, even during examination time, you must make sure that you get You get everything right from the onset. You will notice that in 1.2, we need to use the answer that we got from 1.1 under pay dividend. That concept apply almost, okay, 80% of the patients in financial management will want you maybe to use the answer based on the first answer. Use it in question number 2, 1.2, 1.3, so on and so forth. So you must be careful. You must know your story. Yes. So what is the payout in this case? It's 90,000
90.
divide how many, or number of shares in issue under pay dividend, how many are we having?
Is it not 7,005?
Sorry,
12,000.
it's 12,000. Please check this.
12,000.
Yeah, it's 12,000
Oh,
under pay dividend, not under
Okay.
repurchase, guys.
yes.
Yes. So let me just highlight this. Okay, what are we getting there? 90 divided by 12,000.
7 Rand 50.
Sorry?
7 Rand 50.
Yes.
7 Rand and 50 cents.
Yes. Yes.
Yeah.
Okay, that's our answer. The dividend per share will be 7 Rand 50.
Yep.
And then we are done with 1.2. Yes, if you've got some questions, I guess maybe you can post them on the chat, and then we'll discuss them later on or in another session. Yes. And then
Just
let's
want to
go
ask
ahead.
something.
Sorry?
Just on the 1.1. So 1.1, when we have to put in the answer, do we need to include the repurchase stuff, or is that not asked in this question? Do
Sorry?
we just need to do the shares in issue? For 1.1, do we just need to ask the question, do we just need to answer the stuff that says shares in issue and get the 12,000 shares? Do we need to put in the repurchase part of that answer?
Yes.
Okay.
Only if
Okay.
they have
Yeah, it asks
specified.
for alternative.
Only if they have specified. You see, in question 1.2, they said an alternative of paying out dividend using that. But in question 1.1, they didn't specify, which means we go for both. We are testing both.
Okay. Okay, cool.
Yes.
Hi guys, just a quick one. Good evening, everybody. So Muzi, on question 1, it says test the two alternatives. I just want to check now. I had asked on the side chat there that the last line, the 12,000 minus 4,500, which gives you 7,500 shares in issue. Is that part of the answer, or the answer only goes as far as 4,500?
Okay. The answer basically is 7,500.
For repurchase?
Yes, for repurchase.
Okay.
Yes.
All right, thank you.
Yeah. Okay, let's proceed to question 1.3. Question 1.3 is saying 1.3. Okay, it's saying like, okay, let's calculate like the new share price for both the alternative, which is pay dividend and the repurchase. Yes. Okay. Under pay dividend. Okay, if you want to get a new share price when the company decide to pay out that 90,000, the formula will be as follows to do that. Okay, pay dividend. Just because they didn't specify that, so we need to test both alternatives. So if they come and decide to pay dividend, the new share price formula is as follows. Just because, guys, it's very, very important to play around with the formulas so that you can be in a position to master them. But one thing that you need to know, during the examination time, they do provide you with the formulas. But the best thing to do, the best practice is for you to know the formulas so that you can like try maybe to minimize time of maybe going to the back of the question paper, trying to locate that formula that you want to use. So it's best maybe to have your formulas, the formulas in your head. Yes. Okay. Okay. If you want to get like the price, the new price, the new share price, the formula will be equity minus payout. In this case, I guess everybody can see like, okay, it will be 240,000 minus 90,000 divided by the number of shares. You see, the number of shares that I'm talking about, the number of shares in issue is this 12,000. You can see that 12,000 that I'm highlighting here. Can you see that?
Yes.
Yes. Number of shares in issue. I guess like in our maybe next session, we'll discuss almost, okay, the things in depth. Just because today we are running out of time, we've consumed like 30 minutes already, but you are not done with your question one. Okay, let me try maybe to speed up the process. 240,000 minus 90,000 divide by 12,000. I hope everybody is following. 240 minus 90, that's supposed to be 150 if I'm not mistaken. Can you guys please verify
Yeah,
that?
that's right.
It's correct.
Yeah.
Yes, and then you need to divide that 150 divided by 12.
I think it's 12.5. That's what I
12.5.
calculated.
Okay,
Yeah,
which
12
means
rand,
the new share price, if they decided to pay dividend, it will be 12.50. And then that's the answer. This is the new share price. New share price. New share price. And then now let's proceed. If they decide to do the repurchase, how do I write this repurchase? Okay, if these guys, okay, now we're gonna be focusing on this calculation. You see, guys, we've got this 7.5 here. Can you see that?
Yes.
Yes. So now, just because like the formula, you can see like it's equity minus payout. So we're still going to use that 150. Guys, please note that. New share price here will be like this. Okay. I'll set this. Okay, let me say, okay, new share price so that everybody can follow. New share price will be 150 divided by, see guys, this number of shares in issue that you have calculated in 1.1 under repurchase. That's why I said like you need like each and every number here is very, very important. This will give us how much? The new share price.
20 rand.
20 rand. Yes. If we decide to to do we repurchase the new share price? New share price will be 20 Rand. And then let's proceed. Okay, one thing that you guys need to understand. The answers are in bold. All the answers are in bold. Okay, let's proceed to 1.4. Why do they want in 1.4? I guess, okay, in 1.4, they are looking like they want us to calculate earning per share. But if we can go like to our question paper. Can you go to our question paper? At the top, you see, there is this statement that says current profit are 240 per share. You see, and then if this company, just because, okay, they've just specified that we don't have maybe to calculate anything there. We don't have to calculate anything. This is what we need to do.
Muzi, sorry, man.
Sorry?
Muzi, sorry to interrupt. Unless I'm missing something, I don't see 1.4 on my question.
You are not seeing 1.4?
No.
It's
Yes,
1.3.2.
it's
1.3.2.
Oh, okay. Okay, 1.3.1. Okay, that's why I'm saying like 1.4. Okay, please. Okay, so sorry for that. Sorry for that.
No, that's fine. That's fine.
Okay.
That's 1.3.2.
Yeah, 1.31. They want us to calculate what? Okay, basically that 1.3 I was talking about, 1.31 is where we were calculating like the new share price, guys. Please don't confuse that. And then now we are on 1.3.2. We want now to calculate the earning per share. This is how we go about doing that. Just because, okay, and if they decide to pay dividend, we don't have to do any calculation at all, just because they've specified that the current profit per share, earning per share, if they decided to pay dividend, it will be just that number over there, which is 240. And then now let's go to the second section. If they decide to repurchase, okay, this is how you go about doing that. You see, okay, 240. Okay, just because like you've got this 240 that is there, which is like the current profit, and then now, okay, this is how maybe we go about reaching that stage of getting like the earning per share if we decided maybe to repurchase. Price per share, okay. This is how you go about doing that. Let me just check my question paper here so that I can get this right. Just because I want you guys to get 100%, not 0. Okay. Okay, if you want to get like the earning per share, this is the formula that we are going to use, guys. We're going to say total earnings, and then I will explain this. Earnings is equal to price per share, PPS, price per share. Please note that. Time multiplied by all number of shares in issue. In this case, all number of shares in issue. You remember, like the what? It's 12,000.
Yeah, I thought it was 12.
Yeah, it's 12,000. And then you will say that's 240, which is the current profit, multiply by 12,000. And then what are we getting here? What are we getting?
28,800.
Sorry?
28,800.
28,000.
800.
800. Yes. And then we will then proceed. And then now, just because we want like the new price, just because we've got like the number of shares there, okay, that man which is 28,000. Okay, now the new earning per share. Okay, now we want to get the new earning per share under repurchase. Let me just show you guys so that you can follow. It will be, that's 28,800 divided by 4,500 number of shares under repurchase now, guys. You remember where that 4,500 comes from?
Question 1.
Yeah, we do.
Okay, if I can go back, this is the number of shares that can be bought that we are now using down there. Do you remember that figure? Here.
Yes.
Yes.
Yeah. Where? Number of shares that can be bought. And then what are we getting over there? The new share price.
6 Rand 40.
6 Rand 40. That's the earning per share. That's the final answer. Earning per share. Per share if we decide to repurchase. Okay. Yeah, I guess now we can proceed. And then if you've got some questions with regards to this, please do note them down so that maybe we can attend to them. I hope that's clear to everyone. Let's proceed to another question, to 1.33. Price earning ratio. Price earning ratio. Okay, it's simple. Okay, like you need like to take your time, try to read chapter 1 in your modular guide. Try maybe to understand the ratios, even the theory, so that you can understand the meaning behind each ratio. Yes. And then that will also help you in terms of like trying maybe to attempt questions, and also maybe go into those chapters, just because what we are trying maybe to, okay, question 1 basically is under this topic. Let me just, dividend and dividend policy. So you must try maybe to go through that in your modular guide. As well, you must log into your student portal, maybe try to find more solutions that are related to to this topic. Yes, and then one more thing, maybe something maybe that can help you in other assignment. You find that in your student portal, there is what you call assignment guide. You must go there and try to locate assignment guide for each and every module that you are doing. They will guide you where to find answers for this. Okay, let's proceed without wasting time. Now, in 1.3, they are saying, okay, you must calculate the price earning ratio. This is how we go about doing that. Price earning ratio. Price earning ratio. This is just okay, it's a ratio. It's a ratio. The formula is like this. It should be the market price per share over earning per share. Yes. Okay. One thing that you need to master here is this. Our answers is always in 2. Is always in 2. Now we are dealing with like the first alternative, which is pay dividend. Okay, this is how we go about calculating. The formula is standard like this, which is market price per share over earning per share. Per share. I hope that's clear. Okay, and what's the market price per share and when we pay dividend? Let's scroll up a bit. Let's scroll up a bit. You see, in 1.3 we've done that calculation. We've got that 1250, which is the new share price. You see, market price, which means the current market price when you decide to sell new shares, or to sell the shares. So let me say, now I'm saying to sell new shares. Sorry. Okay, this is how we're gonna do this in rands. 1250 divide by earning per share, and in 1.4 our earning per share was 240. This should be bold just because it's an answer. It was 240. 240. And then what are we getting there? Okay, basically, guys, one thing that you need to master here, this is not money. This is not money. It's a ratio.
5.21. 5.21 times.
5.21. Okay, maybe let's put it like this. 20 into 3 decimal places. 8 times. This is how your answer should look like. It should be times.
Okay.
Not rands. And then when we decide to do repurchase, the formula is the same, guys. This formula. And then the reason why like most of people struggle maybe with financial management is the fact you have noticed how many times we've used the numbers that, okay, the answers that you get prior. You need like to get, if you like you missed one thing, you get one thing wrong, everything that will follow will be wrong. So you must be careful, guys. Yeah. Okay, if we decide maybe to do the repurchase, and then okay, the market price per share for repurchase Let's go and locate that. You see, the new share price, if we decide to repurchase, is 20 rand. Equal to 20 divided by the earning per share in I'm saying 1.4 and 1.5. Why am I doing that? Okay, but please note that it's according to, according to me, I'm saying like it's 1.3 or 1.1, 1.2, 1.3, 1.4, 1.5. But in your case, do the right thing, guys. Okay, our earning per share is 640. And then what's the answer there? If we divide 20 by 640,
3.125.
3.12. 3.125.
125, yes.
Okay, this is our answer. Okay, we are done with question 1. We are done with question 1. When you've got like some questions, this is okay. Question 1 is very tricky. A lot of students get question 1. Okay, they don't understand question 1. Even myself, like it took me time trying maybe to understand what I was supposed to do there. Just because the question by its nature is not that much specific. You see, but this is how you go about answering question 1. With this, supposed to get 100%.
Sorry, can we ask a question about question 1?
Yes,
or do you want us to jot it down?
Okay.
So I'm gonna.
Okay, maybe 1 or 2 questions, just because we are running out of time, guys. We've just finished.
Yeah, I know, not a lot of time.
And then, okay, maybe. Okay, let's do this. Please, try to put together your questions, and then maybe in our next session, just because I want us maybe to rush to question 4 and finish it, and then maybe go back to question 2 and question 3.
Yeah, that sounds about right. I think that 2 and 3 is slightly easier. So maybe.
What's your advice,
we can message
guys?
you separately.
Sorry?
Yeah, can we message you separately or something?
You can post them on the chat, Maggie, and then we'll compile those questions and forward them to Muzi.
Okay, guys, now let
Muzi, sorry, before you go on. Muzi, sorry, before you go on, man, can we get a copy of this as thing being recorded that we can review it later?
Yes, I'm recording
Okay.
this.
All right, perfect.
Yes.
Go for it. Let's do question 4 for now then.
Question 4. Question 4 is very tricky. That's where a lot of students lose it. Even those who have passed. Okay, but if you don't know question 4, I don't think you can pass financial management. You must pay attention on this one. But this one is simple. It's simple. Okay, question 4 is on this topic, the cost of capital. Yes. Yeah, you must take your time, guys. Try to read through that chapter, the theory. But basically here, in cost of capital, okay, there are 2 models that are being used to calculate cost of capital. The first one is the Gordon model, and then the other one is CAPM. Yes, in this case, they've asked us maybe to use CAPM to answer this question. Yes. Okay, I guess maybe we will touch base on the Gordon model some other time. Okay, it's called the dividend. Another name for Gordon model is dividend growth model. You get me, guys? and then that CAPM is for capital asset pricing model. Okay. Without wasting any time, I want us maybe to spend the 15 minutes on this one. 15 minutes on this one. Question 4. Let's go. Everybody should go to question 4 now. Yes. No, Kanya, can you read for us question 4?
I'm sorry, I've got food in my mouth. Can somebody just do it for
Okay.
us?
Okay, that's not a problem. That's not a problem, guys. Basically, here we are calculating the cost of capital. What is okay? Maybe let me just.
I'll read it.
Eh?
I'll read it.
Okay. Just read up until that additional data, and then I'll take over from there.
Okay. Reuter Ltd operates in the commercial painting industry. They have reluctantly come to the conclusion that some of their older equipment is reaching the end of its productive life and will need to be replaced sooner or later. They have asked for your assistance in determining their cost of capital in order to make the decision.
Yes, continue. Hello. Okay. Okay, seemingly we have
Their
lost.
present capital structure is as follows. I'm sorry, I didn't realize I muted myself.
Okay.
So is that 1.2 million 2 rand?
Yes, that's right. 1.2 million, 2 rand ordinary shares.
Rand
now trading
ordinary
at 2 rand
shares. Okay.
per share.
Are now trading at 2 rand 20 per share. 80,000 preference shares trading at 1 rand 80 per share, issued at 2 rand per share, interest at 10% per annum. A bank loan of 1 million at 10.5% per annum, I guess, payable in 3 years' time. You said stop at additional data, right?
Yes. Go ahead and read that additional data. Okay, maybe you can stop there. Let me just maybe explain 1 or 2 things. Okay, if one maybe start a company, there are a number of ways of trying maybe to raise capital for running that company. One of them could be the ordinary shares, the other one preference shares, bank loan. There is also another way called debentures, but in this case it doesn't apply just because it's not there. Okay, and then if maybe I can try maybe to explain what are ordinary shares. Basically, these are the shares that belongs to the owners of the company, the people that started their company, the people who own the company. Yes, ordinary shares belongs to those people, the founders of the company. And then in that bullet point number 1, they're saying, okay, they are 1,200,000 ordinary shares, 2 rand. That 2 rand is the price that those shares were bought, and then now those okay, that's 2 rand 50. Saying like at present moment, the share price has rise to 220. And then let's proceed to bullet point number 2 under preference shares. I hope you guys understand that preference shares basically, okay, let me make an example of Standard Bank. Standard Bank will issue shares for the public to buy. You see, and then those shares, okay, I as Muslim, I can go to Standard Bank and buy shares, not as an owner of the company, but I'm as my investment as a preference shareholder. Preference, this thing is like in English, preference. if I can explain further, the word preference here, which means us as people who have invested our money there, not as owners, we get like the first preference when the shares are being issued out, which means preference shareholders will get dividend. Okay, will get dividend before ordinary shareholders can then get their own dividend, which means that's why they are called preference shareholders. These are investors. It's more like I've invested with the interest of multiplying my money. That's why there is that 10% there, which is an interest. I hope you guys get me there. Do you get me on that one?
We do, we do.
Yes.
So Musi, just to quickly confirm, ordinary shares are those basically owners of the company will have ordinary shares. If I want to buy shares from the public perspective, then it's a preference share.
Yes. Ordinary shareholders are the owners of the company. Preference shareholders are just investors, just like me, whereby I can go to Standard Bank and buy shares there.
Oh, got it. Thank you.
Yes. That's why preference shares has that interest, which is 10% per annum. It's an investment that I made as an individual, not as the owner of that company. Yes. Okay. Maybe I won't explain much in terms of like bank loan. Everybody understand the bank loan. Okay, we've got that additional data. Okay, basically that information, that additional data is the information that you are going to use here. Okay, I would suggest that you go to, I'm not sure in your modular guide, go to page 103. In your modular guide, please turn to page 103. 103. I want us to check the formulas there. Just because now we are about to attempt question 4.1. Let me stop sharing this screen and share my word. We are now sitting at 17. People are so much interested. 4.1.
Yeah, it's supposed to be 15 people, right?
Yeah. That's not a problem. That's not a problem. Let's proceed, guys. Let's proceed. Okay, guys. Are you guys on page 103? I want you to go to the topic that talks about the CAPAM.
Yes.
Okay, in your modular guide, I'm not sure whether it's the same page as mine. Go and cost of capital and then try to locate CAPAM. Yeah.
We got it. We got it.
Yes, okay, let me just read the question here. Assuming that the company uses CAPAM to calculate its cost of equity, calculate its weighted average cost of capital. Okay, it's simple when you use CAPAM, just because the formula for CAPAM is simple and straightforward. This is how we go about when we attempt this question. Basically, when you attempt this question, you go 3 stages. The first stage, that's where like you will calculate the market values and weights of each method of raising capital. The second stage is whereby like you calculate the cost of capital. Let's say maybe for ordinary shares, for preference shares, and then for bank loan. And then the third stage you will do like the actual, we will be doing like the actual WACC, which is the weighted average cost of capital. And then one thing that you must note, guys, please note this. These methods, guys, these methods, Gordon model, oh, these models, Gordon model and CAPAM, please note that they only affect ordinary shares. Only affect ordinary shares, guys. Only. Please note that. Okay. Now let me just insert a table here so that let me insert a table. No. How many rows? Maybe 3 rows. How many down? Put 3, 4.
Muzi, can you share your screen?
So, oh, my screen. Okay, sorry, guys. Sorry, I forgot to do that. I'm now talking on my own.
Yeah.
Where is that screen? Okay. Yes. Okay, this is my screen. Okay, what we are doing here, we are calculating the market values and weights. Okay, without wasting any time, let me just put these headers: capital, market value. Okay, this one, okay, this is very simple. This is very simple. It's very simple. And then we've got ordinary shares. Ordinary shares. How many? 1,200,000. Am I right? What's currently trading at how much?
220.
220. 220. And then you multiply the
50, 20.
Sorry?
220,
oh,
not 50.
All right, thanks for that. Okay, 1,200,000 times 220. How much is that? What are we getting? We are getting. We want to get the market value of those shares currently. That's why we are using like the current price, trading price per share.
It's 2,640,000.
2,640,000. And then let's proceed to preference shares. And then how many? 80,000. 80,000. Current trading at how much? Current trading at how much? Let's look at bullet number 2. Current share trading at 180. Share trading at 180. Can you see that 180?
Yes.
Hello?
Yes.
Yes, we can.
Yes, let's multiply 80 times 1 rand 80.
144,000.
144,000. And then let's go to bank loan. Bank loan, there is nothing that we need to calculate today. Let's put it at 1 million here. 1 million. Okay. This is now money. Just because we have multiplied, this is money. This is in rands. Please note that. rhymes. What have I done? Okay, now let me add one more field here. Let me say total capital. Total capital, can we add up these numbers? That's 2,640,000, 144,000, and 1 million. What are we getting there?
Three million 784.
3,784,000. I hope I'm okay. Okay, this is how we go about maybe calculating the weight. You see, this is more like, okay, that's 3 million. It's everything. That's why I'm saying like total capital. We have decided to raise capital using these three forms of raising capital. So for us to get the ratios, we need to calculate the market value over total capital. Okay, weight is equal to capital market value that you've just calculated, market value, divide by total capital. Let's do that, guys. 2,640 divided by 3,784. What are we getting there?
Hello, Muzi.
Hello?
Hello, Muzi.
Yes, sir.
Yes. Can I slightly take you back? On the bullet number 2, on 80,000 preference shares, why did we take 180 per share, not 2 rand per share? Can you at least clarify us there?
Let me just go there. Okay, sir. As you can see, we are calculating the current market value. The share is now trading at 180, but it was issued. That's why even on that ordinary share, we didn't like use that 2 rand, whereby it was issued at 2 rand, but now trading at 220. I hope that's clear.
Yeah, okay. Thanks.
Yes, okay, let me proceed. Okay. Someone give us an answer there. We're supposed to get a decimal.
1.70.
No. Okay, no. It's not possible. 2,640,000 divided by 3,784,000. We're supposed to get, let me do it this side. We're supposed to get 0.6977.
8. Okay, 77 is good.
Yes, and then 144 divided by 3,784,000. Please, guys, let's try to speed up the process. We are running out of time. Okay, based on what I'm getting here, you correct me if I'm wrong. It's supposed to be 381, like 0.0381.
Got it.
And then on the last one, it's supposed to be 0.2643. Am I correct?
0.2643. Correct.
Yes. Okay, guys, one thing that you need to know, this thing should add up to 1. It should add up to 100%. I hope everybody is following. When you add these numbers, these weights, it's supposed to give you 1, just because these are ratios of this. It's supposed to give, it's more like it will give you 3,784. Okay, now it's time for us to go to the second stage. We are now calculating the cost of capital. Calculating the cost of each capital. Yes. Okay. Therefore, okay, guys, please, we've got that formula for CAPAM. Okay, I won't touch based on Goran. We'll discuss that maybe some other time. The formula is like this. I'm not sure how to put this here. Okay, it's small e. Can you see the formula on your modular guide?
Yes, we can.
Yes.
Yeah.
Yes.
RE equals RF
It's like
plus
this.
beta.
I'm trying maybe to put it. Okay, that B is for beta.
Yeah.
And then I will open the brackets. RM minus RF. Okay, maybe I can try maybe to, but you can see on your modular guide that's okay. That RF is the risk-free rate. RM is the market return. Yes, what we need to do now is for us maybe to do the substitution. It's just simple. It's just simple. Guys, we've got, let's substitute. Risk-free rate. What are they saying about our risk-free rate? Let's go to our question.
7%.
Risk-free rate is 7%. Correct.
Yeah.
That's correct. 7%. And then plus beta.
The beta is 1.4.
1.4.
1.4.
Yes, and then market return is 12%.
Yes, correct.
Minus 7%.
7% of dividends.
Okay, and then one thing that maybe a lot of students that do wrong. Okay, both must do apply here. This is pure mathematics. We start by dealing with something that are in the bracket. And then which means we're gonna be having 7% plus 1.4. 12 minus 7, that's 5%. And then we will multiply. We follow the BODMAS rule. 7% still stands there. 1.4 times 5. What are you getting? 1.4 times 5.
7.
Yeah.
Getting 7%. 7 plus 7. That's 14%. 14%. Okay, this is the cost of capital. This is our answer. Or our ordinary shares are going to cost us this 14%. Now okay. Ordinary shares. That's why I said these two models only affect ordinary shares, not preference shares, not what. Let's go to preference shares. Let's go to preference shares. Preference shares, the formula is simple. It's K, which stands for equity stands for what? It's for capital, and then that small p down there, it's for preference shares. It's simple. D over P0. P0. According to your module, like if you can check like under that topic P0 is the current share price, and then the D. Okay, we need like to calculate the D. D is the share. What? How can I put this? How can I put this?
This is not dividend. It's not the dividend.
Okay, wait a minute.
Yeah, here's the dividend, that's right.
Yes, currently. Okay, there is, okay, in this, if we're going maybe to do even like the Gordon model, there is D1, there is D1 and D. Okay, maybe let me preference shares. You see, I'm not sure whether, okay, I haven't not shared this screen. Under preference shares, we've got that 10%, and then you've got that 2%, 2 rand per share. Those shares were issued at 2 rand with an interest of 10% per annum. For us to get the like the current dividend to be paid, we need to multiply that 2 rand by 10%. This is how we go up. Are you following?
Yeah, we are.
Yes. Okay. The formula is just simple like this. Okay, this is how we go about doing this. We'll say 10% multiply by 2 rand, the price that's why I mentioned that there is D and then D1. Dividend before issuing the next dividend, which means the current price of the dividend. How can I put this? D1, let's say maybe we're in 2020. We have started, the shares in January were issued at 2 rand with an interest of 10%. That's what we are currently working on. But when we talk about D1, let's say in December, okay, January next year, maybe the share price will change a bit, and then even the dividend will change. So that's how we go about maybe having like the D1 and then the D and the D1. Dividend 1, the current dividend, and the dividend that will be paid in the future. Okay, and then we divide that by what? P0. P0 is the current price per share. In this case, under preference shares, we've got 180. I hope everybody is following. And then in financial management, guys, there are 2 ways of doing things. You see, here you can just do your calculations by saying 10 times 2 and get 20. 20 divided by 180 and then get that thing as percentage. Another way of doing that, you can say convert these percentage to a decimal, 0.1010 times 2 and then divide by 180, and then you will get a decimal there and then times 100, and then you will get percentage. But it's another way of doing it. It's another long way of doing it. But in this case, we can just simply say this multiplied by this, we get 20%. And then we have to divide by 180. What are we getting there? What are we getting?
11.1111. 1111. Okay, that's fine.
Yes, that's correct. That's correct. Okay, this is our final answer, guys. This one, cost of preference shares. And then let's go for a bank loan. Now, let's go for a bank loan. Bank loan. This is, we've got a formula, KD, that D is for debt equal to I is interest. I is an interest. Bank loan is this 10%. Oh, it's that 10%, 10.5% over there. And then it's 1 minus T. If you can go like to additional info, you can see there is what we call the current tax rate, which is 30%. I hope you guys are following. Let's hurry up and substitute. It's just a matter of substituting here. And then 10.5%, the open bracket, 1 minus 30%. Okay. Let me just do this in a different way compared to what I've done above. Let me just do this. Let me convert this like this. 100 divide, 10.5 divided by 100. We're gonna get 0. Are you guys following? Yeah.
Yes.
Yes. And then 30% is 0.3. There is nothing that you need maybe to calculate. There is just a simple and straightforward thing. There is nothing to calculate. We apply our Bodmas rule. 1 minus, something is not right here. Something is not right here. Supposed to be like this.
I was about to ask. Thank you.
1 minus 0. It's 0. What? 0.70. Am I right?
Yes.
Yeah.
You're right.
And then we multiply. No. Something is not right even here. Can you multiply that? 0.105 times 0.7. What are we getting? Okay.
0.07.
7. Please round. You must go up to maybe 4 decimal places so that your answer can be close to what these guys are expecting. Just because, guys, you see, we didn't like use this percentage, so we have to multiply this by 100, which is, we are now converting this thing to a percentage. By the look of this, we're supposed to get 7.35%. This is our final answer.
Okay.
Are you guys following?
Yes.
Yes. It's half past now. Okay. Okay. Now we're on stage number 3, which is the WACC, weighted average cost of capital. This is how we do it. Even if you can check in your modular guide on how you go about calculating like the final thing. Okay, the formula is like this. The weight of equity, which is the ordinary shares, and then In this case, just because we're using CAPAM, I will use the symbol for CAPAM, which is RE. Okay, and then plus weight of preference shares times the cost of that percentage, cost of preference shares, plus the weight of debt, which is in this case the bank loan, times cost of debt, that percentage. Please mind that this thing, I don't know what to call this, but it's that small thing. I don't know how to put it, guys. I hope you will understand. Please check like on your textbook on what I'm trying to achieve, just because we are in a hurry. And then the weights, let's go up. These are the weights that you are going to use. In ordinary shares, we are going to use that 0.977 times 14. Are you guys following?
Yes.
Yeah, great. I'm trying to speed up the process here. We are running out of time. And then the other one should be 0. On preference shares, then double check that it should be 0.81 times we got like 11.11%. 11.11%.
Excuse me, Muzi.
Yes, madam.
Hello?
Yes.
The WACC 0.677. Is it not 0.6977?
Thanks for that. 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 It was a typo error. And then the other one, it's 0.2 64
643. Yeah.
43. Okay, yes, 43 times what's the percentage? Is 7.85. It's a percentage.
Yeah, correct.
And then that's equal to, can you substitute, can you multiply this, multiply this, multiply this? What are we getting here? Based on my calculation here, you're supposed to get 9.7678. Am I correct? Are you guys getting the same thing?
Yes, we are.
Yeah.
Yes, and then 0.0381 times 11.11. What are you getting? Supposed to be 0. What?
4232.
423
2.
4233.
91.
If you round it up.
91. Okay, let's proceed. The last one. 0.2643 times 785. Supposed to be 1 and what?
1942.
94.04. Am I correct?
Huh?
And then our work is like this. We add all these numbers. What are we getting?
Just that that last one you worked out, but the times is 7.35. I got 1.9426.
6-1.
Okay. 1.94. Is everybody getting that?
1.942605.
Yeah, that's what I got.
1.942605.
Yeah.
That's right.
Okay, can you add this 9 point something? Let's add everything and get like our weighted average cost of capital. We are done with this question. And then we are now having our 17 marks. You can see how long is this thing. But okay, I think it's much easier if they say like use CAPAM for the Gordon model. It's a bit complicated on that one, just because when you try maybe to deal with the ordinary shares, it's a very tedious process.
We got 12.133696. That's what I got.
12.13. Okay, let's put it like this.
Okay.
Let's put it like this. Okay, basically this is our final answer. Now let's proceed to another question. Let's go back to question 2. Which one can you take? Question 2 or question 3? Question 3 is simple and straightforward.
Yeah, I just wanted to ask you, that was a theoretical question, and in the guide, there's exactly that. So I want to see if that's exactly the same answer in the guide. Or
Yes,
is
this
something
thing of, okay, proceed. Sorry.
Yeah, no, so this is exactly in the guide. I can't remember which page. I'll check it now. But basically, if we take the same thing out from the guide, is it correct exactly as it is in the guide?
Okay, for question 3, maybe let me just do this quick. I will share a certain slide so that it can be recorded here. Let me just stop sharing this.
Sorry, before you go there, I just wanted to ask, are we focusing on 4.2?
Oh, they still 4.2. Okay, even 4.2 is simple, guys. It's very simple. It's very simple. It's very simple. Okay, let me just I don't wait that. Okay, it's very simple. And then, okay, yeah, a further 800,000 is needed to finance the expansion. Which option should they use, from ordinary share, preference share, or bank loan financing? Okay, the answer is very simple, guys. This is what you do. You see, on preference shares, we got, or ordinary shares, we got 14% as a cost, which means ordinary shares are very expensive. We don't go for that. And then preference shares is 11.11%, still expensive. But the bank loan, the cost of capital for a bank loan is 7.5. The answer there is simple. We will go for a bank to get that 800,000. We will go for a bank loan just because the bank loan is cheaper than the other forms of raising capital. That's the answer. Is that clear?
We got you.
Yeah?
Yeah, it's good.
yeah, okay. Okay, no, let's proceed.
So we go for a bank loan?
Yeah, just because it's cheap.
Because
Its cost of capital is cheap, is 7.35%. Compared to 11.11 for preference shares and 14% for ordinary shares. So which means when we take a bank loan, the bank loan will be cheaper for us compared to the other forms of raising capital.
Sorry,
Hey, thanks.
can you, all right.
I'm listening.
Can you reiterate that we opted for a bank loan because it's cheap, right?
Okay, okay. For us, maybe to understand this thing. For a bank loan, okay, for ordinary shares, the cost of capital is 14%. Check. Okay, maybe let me share this just because maybe some of you don't. Let me share my screen. Let me share this screen. Which one? Let me hope I will share the right thing. Yes. Okay, guys. Bank loan, 7.35%. The cost of capital. Preference shares, 11.11. And then for ordinary shares, it's 14%. And then what I'm saying, we will go for a bank loan just because it's cheaper than going for ordinary shares or preference shares. The cost of capital is cheaper. When we take a loan, it will be much cheaper. It will cost us less compared to advertising shares or adding maybe another business partner in our company. Just because, okay, and then one thing maybe that confused like a lot of people. You see, even if you are an owner, the whole purpose of like starting a business is to gain something out of that business. So that's something that you are going to gain. That's the cost. I will invest 2 million into my company with the hope of getting returns in dividends each and every year. Even if when I buy like shares at Standard Bank, I'm having that hope that by the end, okay, maybe in June, I will get dividend, and even December, I'll get dividend. Even if we go for a bank loan, when you take a loan, the loan will come with an interest, which is a cost. That's the cost of capital. The money that you get out of it, the owners of that money want to get returns. So basically, cost of capital is all about that. And then we need to weigh like the best options to go for. I hope I'm clear on that one, guys.
Yes.
Yeah.
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 Okay,
Yeah.
let's proceed. We are running out of time. Yo.
Yes.
We are really running out of time. Now let's go forward. For question. Okay, I wanted to share something with you. Let me see whether. Oh, now, just because that question, which question? Question what?
Question 3.1.
Question 3. Basically, it's about credit analysis. Auntie, do you understand that?
Yeah.
Sorry?
Yes.
Dinesh, where in the guide is this you were saying that it's exactly there?
Page 157. Just check page 157.
Okay, guys. If maybe I can try maybe to explain question 3. Question 3, they are talking about that. Okay, here you will assume you will give, let's say maybe I go to where I go to maybe to a car dealer and buy a car costing 100,000, and then the dealer will say, if I pay in 10 days, I'll get a discount of 2%. If I don't pay in 10 days, I prefer to pay in 30 days. That discount of 2% on. So how do you go about maybe answering this question? And then, okay, okay, yeah, I'm getting some WhatsApp messages. Okay, some of you guys are requesting that we add the 30
Expose
more
me.
Okay,
Why
that's
don't expose?
yeah. No. I'm supposed to communicate this. I'm supposed to communicate this just because some people got some other agendas. You want to watch Generations now? It's 8. Okay, guys. For question, okay, that's 3.2. I want just to give you like a quick guide. Please go and read.
Muzi, sorry, man. Muzi,
Yes.
while you're doing that, I just want to double check, right? In the guide, it's exactly the same question as it is here on the
Exactly the
assignment.
same question.
Yes.
Okay.
And
Okay.
it says,
Let me just do this. Just a simple thing.
yeah.
Okay. Question 3.2, guys, is in the modular guide. There are 4 points there. Please read that. Aims of appraising a project. There are 4 points in the book. I guess it's on page. If you can start on page 60, according to my modular guide, or page 60, read there, you will come across the aims of appraising a project. Okay, let me go back to 3.1. Okay, okay, I want to share my screen here. Okay, sorry.
That's me WhatsApping you what's on the guide. It's exactly the same question for 3.1 and answer. That's what I want to check.
It is the same, eh?
Yeah, that's what I just want to double check, so we don't waste time. If it's exactly the same question, same answer, and you be happy, then you can move
Okay,
on.
sorry, guys. I was just checking on something. I'm seeing quite a number of messages coming on my phone. So I want to share this, guys, so that it can give you guys a clear picture. On what is expected there. Can you see that slide that I've just okay, maybe let me just a bit. Okay, I think it's this one. Is this one, slide number 8. Can you see that slide that I've just shared with you?
Yes.
Hello? Yes. If we can just go to bullet point number 2, Lawrence Industry Limited purchases 1,000 weight of merchandise on 27 February from a supplier extending terms to his net 30, so on and so forth. If the firm take cash discount, it will have so on and so forth. This, which means the discount even here it's 2% just because it's 0.02. This is how you go about maybe answering that question. You will have to state your figure. Let's say, for instance, in your case, it's 100,000 minus 2%, just because even in our case it's 2% times 100,000, and then you will just, even on that question they say assume, and then you will get 20 rands. Okay, in this case it's like $20. That's the discount that you are going to get if you have paid maybe in 10 days. But if you have extended to 30 days, you won't get this discount. And then basically that question is saying like, what is the implication of this? Explain this. What is happening? If we go to slide number 9, that's the answer there. Okay, first thing, you need to do this calculation, something similar to this. And then you explain. If this film goes for okay, pay within like 10 days, they will enjoy so much discount. But if they go for now, they will just lose, they will pay like the full amount. Basically, this is what question 3 wants. There is nothing complicated. Are you following?
Yeah, Muzi, I want to ask quickly. So the question doesn't give you an amount. Do we need to assume an amount and put that in?
Yes, yes. That's why it's saying assume.
Okay.
That's why it's saying assume that a film is offered. And then you need like to specify and show like the calculation. And then after that, you need to explain with what I've shared on that slide. Slide number 9. Oh, you don't see that 9. Okay, yeah. Okay, let's go to question 2 now. Let's go to question 2. Let me stop sharing this.
Sorry, Moses, you're going to share these slides with us? Oh.
The slide.
Oh,
no,
how do we get
my slides?
Oh, is it? Okay. So we needed to copy that down or what?
No. Okay, no, you're gonna get the, okay, if you want those slides, you can get them.
Oh, thanks.
If you are interested. Okay, let's go to question 2. Question 2, everybody should go to question 2. Question 2 is long, I don't want to lie. It's long. Question 2 is very long. Okay, that's investment appraisal. We are now appraising projects. We are now appraising projects. My eyes are now complaining. Yo. Investment appraisal.
You can send us your sample answer.
Sorry?
You can just send us your sample answer. Since you're running out of time. And we work to the rest of this question.
Yeah, I think that's a good idea, Naresh.
Okay. Guys, like you have I've talked and talked. Are you guys getting something out of this?
Oh yeah, absolutely.
Yes.
Yeah. Absolutely, for sure.
Okay,
Yeah,
that's great. That's great. Then.
Absolutely, definitely.
Happy. Okay.
Yeah, I think you're almost done. So if maybe you can work that out in your time and you email it through to us. You've got our email addresses. Because I think you've covered the bulk of what needs to be covered for now.
Work out question 2.
I think this is ready.
But okay, maybe let me just explain.
Yeah.
Let me try to explain to you question 2. Question 2, okay, question 2 is very simple, but it's long. You see? Okay, basically on question 2, we've got, okay, it's under investment appraisal method. There's quite a number of them. Okay, I'll read that. What limited is an option to invest in project XX. The following information is available for a project. Okay, yeah, guys. Investment is 280,000. Scrap nil. Expected lifetime is 5. Cost of capital, 12%. And then we've got profits and cash flows. Okay, there are things that you need maybe to note here. You see that the column for profits, we're going to use that to calculate the accounting rate of return. Please note that. And then the cash flows, use them to calculate the payback period. You also use them to calculate the net present value of the project. Yes. Okay. Okay, let me open page 60 here so that you can quickly attempt to do the accounting rate of return. Accounting rate of return. Can quickly do the accounting rate of return. Okay. Basically, this is what you're supposed to do just because we've got these profits here. The formula for calculating like the accounting of the rate of return is average profit over average investment times 100. Average profit, this is how you're going to get average profit. You add 23,000, 26,000, 40,000, 43,000, 14,000. 14,000 and then you divide by 5. And then that's the average profit.
Yeah.
Or you want me to demonstrate that, guys? You want us to do that quick?
Yes,
Okay.
quick if we can do that.
Sorry?
Go for it.
Yeah, no, we're saying please, yes.
Yeah, go. We're not watching Generations.
Yes.
We can miss out on the 8 o'clock appointment today, please.
We'll catch up tomorrow.
Yes, please.
Yes.
Sorry, you say like you must do that.
Yes,
Please.
go for it.
Okay, let me try to open this. Okay, it's not a problem. Let me share a screen. This screen here. This word. Okay, right now, if you guys can just do me a favor, just add those profits together and divide by 5 so that you can get the average.
I got 29,200. But someone just needs to check it for me.
Okay. Question 4. Question 1. Question 2.
Yeah, I got the same.
Also got the same.
Question 2.
29,200.
Okay, the AIR is equal to average profit. Profit over average investment. Investment times 100. And then I said you guys need to add those profits and divide by 5, the 5 years. That's 5 is the 5 years. What are we getting?
29,200.
29,000. Who is this? Sorry, guys. Can I take this? Somebody's disturbing me. 29,000. How much? Hello.
29,200
29,000.
and 200.
200.
Yeah.
Over. Average. Okay, guys. Average investment, if we were having something like a salvage value, we're supposed to add that. If we want to get like the average investment, let me just check the question. Let me
So it should be your residual value plus your initial investment.
We don't have a salvage value. We don't have the salvage value. And then okay, cost of investment here to okay, our investment here to according to this is how much? Cost of capital. Or investment yet is 280. Which means in this case, just because we don't have what we call salvage value, we'll just divide that 280,000 by 2.
Divide by 2.
By 2.
Give you 100
Remember, we want to get an average investment. Average investment is equal to.
Sorry, Muzi, there's somebody in the lobby that was just kicked out.
I don't see anyone. Can you attempt to? Okay. All right. Okay. You will get accepted shortly. Okay. That's not a problem. That's not a problem. Which means average investment it will be that 280,000 divided by 2. What are we getting there?
It's 140,000.
140,000.
Yeah.
Can you just quickly explain why are we dividing by 2, not 5?
We are getting an average investment, sir.
So there's a formula. The formula is
yes,
everything
there is a formula for getting an average investment. If we were having a salvage value there, we're supposed to say that investment plus salvage value divided by 2, and then from there we will get the average investment.
Yeah.
All right, thank you.
And then now we'll use our formula, this formula. Can we substitute based on the figures that we are having now? This is equal to 29,200 divided by 140,000 times 100. What are we getting? 29,000. Can you try maybe to speed up this? 29,000 over 140,000.
Yeah.
How much are we getting here?
0.2085. How far you wanna go?
0.20 or 0.2085.
7.
Sorry?
No. 714.
714. Can you multiply that by 100 so that you can get our AIR?
20.8571.
Sorry, 20%, 20 point. 0.86. Let's say 86%.
Okay.
Correct.
Yeah, like this. Okay, basically this is our AIR. Yeah, if maybe you can go to, okay, just because I believe that people should try maybe to
Sure.
find
Muzi,
some
do you
answer
mind
on
saving
this.
the document that you're working on?
Yes,
Sorry?
please save. Save that document, Muzi.
I should save the document.
Yes, save the
Please,
document.
Baba, please.
Why?
Yes.
You
No, I
must
will
save
save
Muzi.
it. I will save it. I trust
We'll
my
take a
machine.
vote.
Don't
All those in
worry.
favor say Muzi.
Don't
Say
worry,
yes,
guys. I will save it.
and share.
Yes. We just need to
Okay, now
compare it
let's go
against the
to
work we've done
let's go to
already.
2.2 for the payback.
Yeah.
We are done with the ARR. Let's go to 2.2 for the payback. Payback. Now we are.
Sorry, Muzi.
Yes, sir.
Sorry, Muzi. Muzi, that 29,200, is it average profit?
Yes.
I mean, how did you get that? Where did you get it?
Okay, simple. Let's say maybe we've got like ages. Okay, if you have done like statistics analysis, let's say maybe we've got ages 10, 12, 10. For you to get an average, you need to sum up the ages and then divide by 3. In this case, we've got this profit, and then we divide by the number of years, which is 5 years. And then we get the average.
Oh, I see. Okay.
Yeah.
All right. Thank you, man.
All right. Okay. That's the problem. That's the problem, sir. Yeah, we have helped quite a number of people. I know. Okay. Let's go to 2.2. We are running out of time. In 2.2, we need to create a table. We need to create a table in 2.2. That thing is done on a table. You don't just do it. Okay. Okay, wait a bit, wait a moment. Payback period. Okay, our table need to have like 3 columns. Just because it's 5 years there, how many columns? 1, 2, 3, 4, 5, 6. We need 6, 3 by 6 column. We need 3 by 6 column. This is 2.2. Then I have to insert a table here. Wait. 2, 3, 4, 5, 6. There we go. And then, okay, when calculating the payback, we don't use profit. We use what do you call these? Cash flows. That you must master. Okay, our headers will be as follows: year cash flow and cumulative cash flow. Yeah, cash flow, cumulative cash flow. cumulative cash flow. Cash flow, how many years? It's 5 years. 1, 2, 3, 4, 5. Okay, guys, can you read for me the cash flows? Please read for me the cash flows.
70,000.
79,000.
Oh, cash flows.
Cash flows on the question paper. It's 79,000 in year 1, year 2.
82,000.
Sorry?
82,000.
82.
82,000.
82,000.
Year 3.
96,000.
92.
96.
96,000. Year 4.
99.
99 and 70. 99 and 70. 99 and 70. 99,000. 70,000. Okay, guys, and then this is how we go about doing this cumulative thing. Okay, like the first cash flow, year 1 is 150. We don't do any calculation. Sorry, it's not 150, 79,000. 79,000 plus 82,000. What are you getting?
161,000.
Sorry?
161,000.
161,000. 161,000 plus 96.
257,000.
Sorry?
257,000.
257,000.
Next one is
357,000
356,000.
plus 99,000.
356.
356,000.
And the last one is 426.
Sorry?
426. 426.
426,000.
Yes.
Okay. The rule is simple here. Okay, what is our investment, guys?
280,000.
280,000. Okay. You see, 280,000 lies between year 3 and year 4. Year 3 and year 4. You notice that?
Yeah.
Okay. If maybe you can go to your textbook, to your modular guide, on page what? Where can I find the payback period? Payback period is being illustrated, shown on page 57. Okay, according to my modular guide, being shown, you can navigate to that under investment and appraisal and go to the topic that talks about payback period. You see, just before we reach to, sorry?
Page 56.
Yes,
in our one.
somewhere there. You see, between year 3 and year 4, that's where we are going to get our investment. And then which means our payback period will start on year 3. Do you notice that? Year 3. It should be 3 years so on and so forth. 3 years, 3 months, 10 days, things like that. Are you with me? Now, just because we have done this, let's now go to the formula. I think even in your, how do you call this? In your, okay, the formula is like this. It's like this. Year before fully recovery, payback is equal to year before full recovery. In this case, that's why I've highlighted that 257. Are you guys following? And then from there, but there is a simple way of doing this thing. It's just a simple formula that says A plus B over C. Yeah, let me just put it in that way. Okay. Okay, plus unrecovered cash flow at the beginning of the year, plus unrecovered. Okay, in words, it's like that, plus unrecovered cash flow in the beginning of the year. All these divide by cash flow during the year. Cash flow during the year. Cash flow during the year. Okay, basically this is the formula, but you can put it like this. It's equal to A plus B over C. Simple like that. Okay, in this case, okay, now let's substitute. It's time for us to substitute. We want to get the payback. Let's substitute. Okay. Our investment is how much? Is 280. We need to say, for us to get B, we need to say 280 minus 280. For us to get B, we need to say our investment, which is 280,000 minus 257,000. What are we getting there? First, guys, we are running out of time. We're running out of time. We are running out of time.
23,000.
23,000.
Yes.
Okay. Let me just.
Yeah, that's right.
Okay. Okay, now it's simple. It's simple. Let's substitute. Okay, the formula now, which is like the payback. Which is the payback. This is how we're going to do it. This is how we're going to do it. Years before full recovery, which means it's 3 years. 3 years. It's 3 plus how much? What is B? 23,000.
26,000.
Yes. We divide that. Cash flow before now, which means we divide that by 99,000.
Cash flow during
During the year. We divide by 99,000.
Yeah.
Can we substitute that? Okay. This is how we do this. This is how we do it before we mess up everything. Before we mess up everything, let's do this. Payback is equal to 3. And this is how you do it. It's very, very simple. What you need to do, you will just leave that 3 years. That's 3 years. You will divide 23,000 with 99. What are we getting there? What's the answer?
0.232323.
0.2323. 2323 like this.
Yeah.
Okay, our payback is equal to 3.2323 years. But the answer your question said we must put this in months and days.
Correct.
Yes.
Years, months,
This
and
is what
days.
you do. This is what you do. You continue with your 3, and then now we are remaining with that point 0.2323. For us to get the months, can you multiply that by 12? What are we getting?
2.7878.
2.7878.
Yeah.
Okay. Our answer now will look like this. Payback is equal to 3 years, 2 months. That whole number, that's 2, it's months. And then now we are left with 0.7878. Can you multiply
if we
that
round
by
it off, sorry, Muzi, sorry, if we round it off, it should be 79, not 78.
79?
Yeah, to be correct.
Here.
Yeah, correct.
79.
79,
Okay, that's
yeah.
fine.
And the bottom.
Can you please multiply that by 30?
By 30. 83.64.
Sorry? 83?
Yeah, I'll give you 4 digits.
No, it's not
83.
supposed to be like that. Are you sure?
No, it's not. It's not.
0.
It's 23. 23
Oh,
days.
23. Okay. 23. 23 point
637.
637. 637. Okay. Our final answer for our payback is going to be 3 years, 2 months,
4 days.
23 days. That's the answer.
Can you give them in minutes as well? You can add minutes.
Yeah, if you continue, you can go up to minutes, so on and so forth. You see, like, we are still having this remainder here, which means we can still generate hours, so on and so forth. But
Yeah,
our
no, it's
paper
fine. Just kidding.
is like this. That's our final answer. But at some point in time, you find that you just, your answer, you will just stop where? Where is that? You will just stop here. But just because here they've specified that, okay, they want this thing in months, in years, months, and days. So that's why you've gone an extra mile. Yo, I'm so tired now. Yo. Okay. Guys, I know I'm not okay. If the payback cut-off is 3 years, should the project be chosen? Yes, the project should be chosen just because the payback period of this project, okay, 3 years is less than the payback period of this project. We've got like a payback period which is 3 years, 2 months. So in this case, which means, okay, they can continue with this project just because the payback period, okay, 3 years is less than the payback period. That's the answer. Simple like that. Yeah, the net present value. Yo. I guess you guys are going to do that. It's quite lengthy, but okay, it's similar to this payback thing, but different a bit. Just because now on those cash flow, we need like to calculate the present value of each cash flow, and then get the net present value. But we have run out of time, guys.
No, just this one.
Yeah.
Shall we have another session?
Okay, maybe we can have another session. Yeah.
Sorry.
Well, I was
See, if you
saying
say the word format, that will also be fine.
Yeah. Okay. I don't know.
Muzi, I did suggest you can calculate it when you've got time and then just send it through to us. We can have a look at it.
The answer.
Yeah. On whichever ones we didn't cover, you can. Well, we did it anyway.
Okay. That's not a problem. I don't know when am I going to get time maybe to do this. Maybe over the weekend if I get time.
Yeah, what about it?
But there is also question 5, guys.
Over the weekend, guys.
Question 5. Question 5 is just simple and straightforward. You need like to read the ratios and try to attempt that.
Musi, book me another session, man.
Sorry?
Yeah.
Book me another session. The session was worth it. You can book me another session.
It was worth it. All right, I'm happy, guys.
All right.
This session add value to your studies. So like, yeah. I'm really not sure when
Can't we have another session?
When okay, some next week it's hectic, very hectic. Tuesday I've got like series of meetings, and then Thursday I've got series of meetings. Okay, maybe let's say what about Sunday?
This Sunday.
Yes.
I'm okay with that.
Yeah, that's fine.
Yeah.
Sunday, maybe let's say
Sunday afternoon.
Yeah,
Sunday
afternoon. Maybe sometime around the 3.
That's okay with.
Yeah.
Yeah, that's good.
Yeah,
guess it will
okay,
be
guys.
good.
I guess that's it for the day.
Yes.
I will share like the video of this thing. I will upload this
All right.
this video on WeTransfer, and then I will share the link.
Thank you. Thank you, Muzi.
Okay.
Thanks so much. Thanks so much for arranging.
Thank you.
Bye.
No, okay, can you guys still hear me?
Yes.
Yeah.
Yes.
Okay, so I've just shared a link on our WhatsApp just for the purposes of continuous improvement, you know, just so that Muzi also know what's working for people and what's not working. Maybe if you can just put on your comments on that link, and he can also do the same. Your responses will remain anonymous. We just want to see how can we improve the session itself, you know, the next time we have it, which is Sunday, so that, yeah, we continuously get better at this and we get more and more value out of it. All right, it's going to take you 2 minutes, literally.
Okay.
Okay, that's not a problem. And then what else do I wanna share with you? Okay, on the chart, I've shared a certain domain for my Investopedia. For Investopedia, if you wanna learn more about these financial things, economies, so on and so forth, investment, you can check on that link. There is everything that has to do with finance. And then, okay, guys, one thing that maybe I didn't like share with you. Remember that here you are writing an assignment. Okay, in financial management, they usually they don't care about referencing, but at least provide those 5 references in terms of where they ask you like the theory. Try maybe to research a bit, and then
bibliography.
reference, do your proper Harvard referencing, and then submit. Yeah, I think that's it for the day. Goodbye.
Thank you, Muzi. Thank you, everyone.
Thanks,
Thank you so much, Muzi.
Bye.
Thank you all.
Thank you, bye.
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 Yeah.
Thank you,
All
everyone.
right.